Hey everyone, this is Omar from Trinity Trading. Wanted to go over a kind of interesting concept in trading that isn't really talked too much about. I think mostly talk about technical setups and entries and exits. But one thing we don't really talk too much about in the trading space, which is something I've learned over the years, is how to dynamically size into a trade. So I'm going to talk about this topic just real quick using an example from today's watch list and a trade we actually took in the Discord today. So this is Goldman Sachs GS. Had a really strong close yesterday, gapping, not gapping, but just under a new all-time high. And so pre-market, we had this idea on Goldman Sachs uh, basically through 750, 752. Um, we were looking to take a trade, take some calls through this level because it's a 52-week high breakout. And, above 750, 752, you can catch good amount of points up to originally thinking, 759, 764, 769, etc. It's an all-time high breakout. This is pretty classic momentum trading through an all-time high breakout. So it's kind of bread and butter here. So what ended up happening today was, we got through this level near 750, and the price action here just there was no real momentum through until kind of mid morning here, but it ended up fading, and now we're just hovering around 750, right? It's not really breaking out, but it's not selling off either. So I want to talk about how we traded this and what we did to make sure this doesn't turn into like a big loser if it does fail. So um, I have the contracts we traded here. So we traded the Goldman Sachs September 12th 800 call, and this is a 15-minute chart of that option. So I can kind of talk through what the premiums were doing while the stock was trading. So we entered these calls at 1.9 within the first 15 minutes of the open, just before 15 minutes. So it would be this candle here, right near the 749 area. Okay, so we enter at 1.9. As an initial kind of pop here, and premiums actually went from 1.9 to 2.2, right? So it started off pretty well, considering, GS moved about a point. So really good start, went to 2.2 from 1.9 on a really small move, right? We didn't trim anything because we're literally just starting the move. It would be a little premature to trim into that. And so what ended up happening was we saw a small reversal here at 750, kind of dipped back down to 746. And to be honest, like it's at this moment in time where you're like, oh God, the all-time high breakout is failing. But we held the trade, came back up to 750, started to move higher, reversed a little bit, and then it had this like really nice move all the way up to 753, which is the current 52-week high now, intraday. The issue is the premiums never came back to that 2.2. So we saw the highest premium within the first couple minutes of entering the trade. And what ended up happening was when we hit 753 up here, which is about 2 to 3 points higher from where we entered, the premiums were still around 2.1, 2.15 maybe. And to me, when you're trading options, you really need to be hyper aware of how your premium is trading, because ultimately that's the asset that you're trading. I'm not trading Goldman Sachs commons. If I was doing that, I'd be in at 749 and still be in profit here, right? I'm in an option, and the more you see this kind of like slow price action, the more this option is just going to deteriorate throughout the day. So the way we played this was essentially around 753, we saw this reversal come in, and we took off and sized down at 2.05 from 1.9. So barely, not even 10% on a call, right? And we never, our minimum is like 20% for a first trim. So us trimming at 10% means we're not super confident in the trade anymore. And then eventually we just cut it at 1.8, right? So about 10 cents under our entry price. And essentially this became a scratch trade, unfortunately, even though this was like a really good setup through 52-week highs. But what you have to really consider is the risk I'm putting up in the market, am I getting paid to put that risk on, or am I not getting paid? And we were not getting paid. So the more time you have risk in the market, the more chances are more opportunity there is for you to win, but also for you to lose. And as momentum traders, we need to see momentum, right? If there's no momentum, then the trade is not going to be working for us, and therefore we're just not going to be in it. So, with Goldman Sachs, maybe this thing runs tomorrow or later in the week, but for now, we're just going to sit and watch it. If there's another entry, if premiums start looking better, if there's more momentum, we'll certainly try this again because it is at all-time highs, and that's a great place to be for a momentum trader. But dynamically sizing in and out of a trade based on the underlying price action is very important. It's a very important concept to learn as a trader, and this was a really good example of how you can manage a trade once you're in it based on the underlying premium moving and the stock moving. And you can assess whether or not you want to stay in the trade or continue to hold for a bigger move. But yeah, I hope this all made sense. If you have any questions, let me know. This is meant to just be like a quick sort of short video talking about a real-time example of where you can use the concept of dynamically sizing in and out of a trade while you're watching the price action. Okay, back to the markets. See if anything's moving. See you guys all back in the Discord. Take care.